Welcome to our video report. This is Ramesh Sigamani from Bravisa Temple Tree. Wishing you a happy new year 2018 for all our viewers. As the curtains came down on 2017, Sensex made yet another history by closing above 34,000 for the first time, giving 28% gains to its investors for the full year and making it one of the memorable years of investing experience. In spite of many challenges like the crude oil price rise, DOCKLAM standoff, uncertainties in Gujarat elections, uncertainties in GST implementation, North Korea warfares, PSU bank mergers, US interest rate hike, and uncertainties on the taxation of long-term capital gains, markets kept going higher and higher. Amongst the loud cry from the media that valuations are overstretched in our market, liquidity of money kept pouring in, both in way of bulk investments and SIPs. SIPs today have touched 6,000 crores per month, together bringing more than $10 billion of retail investment into the market year after year from now. This huge flow of money helped mutual funds absorb all kind of selling pressure, including FII selling. For the first time in India, FIIs were made to run for their money. They will get out of the market thinking that markets are overvalued and will only be coming back to buy at higher prices again. Papers, metals, and chemicals were the best sectors of the year, along with the consumption stocks that picked up momentum after the GST implementation. In our portfolio, we hold investments in the best of sectors and give high exposure to sectors that have very high potential for growth. Let's look at how we have performed against the Sensex in various time frames. In the last 5 years, Sensex has given its investors 11.88% per annum return. The same period, our portfolio has managed to give 23.47% return, which is almost double than what Sensex gave to its investors. For the full year of 2017, Sensex managed to give about 28% return, while our portfolio managed a stupendous 71.89% return, and it is the best among all the diversified portfolios that are available in India today. So this being 2017, what is going to be the story in 2018? Normally, after one good year, the following year will not be so euphoric, while this time it is going to be slightly better. There is expectation that 2018 will have a positive close. The reason behind this euphoric or optimism in the market is that this year is going to be the last year of full budget for this government, which is expected to bring huge populist outcomes. There is state and general elections lined up where expectation of spends is around 15,000 crores, which should have the markets kept on the rise. Expectation of reduction in GST, which will increase consumption. Huge emphasis on creating jobs and income growth for blue collar segment, where the consumption is likely to come and boost the economy. Huge lineup of IPOs both in the government and the startup segments, which will absorb any kind of liquidity that is going to come into the market. No positive surprise on the crude oil side, as there is shale gas giving competition at $63. Then disruptive technologies in automobiles like driverless cars, electric cars, more penetration of Uber and Ola, which is likely to bring down automobile population on the road and thereby reduced demand for crude oil. All these are expected to boost and keep the market at higher levels. 2017 was a year with good gains where mid and small companies made fantastic returns for its investors. While it is not going to be the same in 2018, we expect moderate returns along with good amount of volatility in prices. Thank you. This is Ramesh Sigamani from Pravisa Temple Tree signing off. Have a great day.